All right, everybody, welcome. Doug McKay on the last day of the quarter, March 30th, 2012. For the 15th week in a row, we have the overall trend in equity markets as long. We're looking at a daily chart of the S&P 500, closed at 1408 and change on Friday. And this is a post that we put out yesterday, Thursday, on the 29th. And I think I put this post out when the S&P was down maybe 10 or 11 points. It rebounded significantly. I think to close down only two and change on Thursday. So we put in a hammer formation on this candle yesterday. We still are below the highs of a couple weeks ago. I think this is right around 1414. Yeah, 1414 was this high. Again, we closed today at 1408. Potentially we have a mini head and shoulders topping formation here with the head here, the left shoulder at 1414, right shoulder. I do like the chart of the Dow a little bit better. We'll talk about that later, but let's talk about levels here where we would want to hold or see hold. We would definitely sit up on our seat, take notice if we were to take out the lows that were put in yesterday around 1391. Let's just call it 1390. We think if we press 1391 through it, we're going to support, which is at 1380. If that doesn't hold and we make a series of lower highs and lower lows, we think we'll kind of chop our way down to 1360, which would be the 50-day moving average. At some point, you know, the odds are huge that we're going to hit the 50-day moving average at a minimum. Now, if price continues to rise, obviously the 50-day moving average is going to rise as well. So we'll see. The overall trend is long. Our position right now, both in the managed accounts and in the 4-minute traders, I guess you'd call it moderately bullish. Mostly cash. So we'll see. If we break out on the Dow to new highs, we do have a rising trend line here against kind of a flat top. That puts the pressure upwards. So we did take a position this morning in the diamonds, thinking that we're going to get through 13,250 on the Dow, which would push up against these highs here. If that does not work and we take out 13,000, we will look to exit that position, even if we have to take a loss. Now, let's just take a worst case scenario. We come down, we get out, we take a small loss, and it stops falling and we head back through 13,250. What would we do? We would buy back at a higher price and increase our size long. All right. So as always, you're only going to hit resistance, resistance to ceiling so many times, and you're going to break through it to the upside. And the same goes with support. So we'll see. But the overall trend is long. Volume is low. We know that the investor sentiment is high. So that's a contrarian indicator, but it is what it is. The tape is moving up. The trend line is holding. Let's take a look at the transports. Transports are still lagging. Had a nice move here with volume. We are back above the 50-day moving average, but we are not at new highs. We'd kind of have to see a close above this level of 96. Let's take a look at bonds. We knew this would bounce, right? We were actually looking for an entry at 116, a little over $100. We never got that. But based on this candle action, we knew that the odds were high. I don't want to say we knew, but the odds were high that we were going to come back and fill this gap. It did yesterday and today, and then just got slammed long bonds today big time, especially the long end, the TLT. But in any event, this was an opportune time to get short bonds. This all happened intraday, so I missed this move and I did not have a buy order in. But if we fade a little bit here, maybe pull back to 20 and change or 20, we will put on a position shorting bonds, long TBT with a stop. This is double short bonds, so you got to give it a little more room, but probably a stop around the 1920 or just a little bit above it. But the main reason I wanted to show you this chart is it did fill the gap here. So more often than not, you're going to come back down and test the most recent breakout area, right? We talk about that all the time. Breaks out here, whatever it is, stock, bond, breaks out, right? Gets above this area, comes back down, tests it, and it usually bounces off it. Again, as always, you're only going to test it so many times, and it's going to be a failed bounce and breakthrough. I do want to talk about head fakes and failed breakouts, because you have to be aware of these. This was a failed breakout here. Long bonds. I'm sure there were some buy stops hit here. I'm sure there were some shorts parked above here, taken out. But again, you have to be aware that this can happen, and you just have to exit and take the small loss. We didn't have a position at that time, but this is an example of what could happen. It could happen to, as an example, the Russell. We held off on getting long the Russell. We like this chart. The inverted head and shoulders, the cup and handle, the highs on a daily chart, weekly chart, monthly chart. We like this chart a lot, but we knew this gap would come more often than not again, and high probability get filled, not right away, like a day later or 2 days later, but we thought it would get filled. But the reason I bring this up is this could have been a false breakout. It still may be a false breakout where we closed above 84 or got above 84 on Monday. So what would we do now? We'd want to see a comfortable close above 84 to confirm that this was not a false breakout, and to confirm that we are holding some type of trend line in here. Again, we would keep our stop tight, no farther back than 81. So that deals within our risk parameters in terms of a percentage stop away. So we like the Russell above 84, but stops are tight, 81, 81 and change. We like the diamonds, tracking the Dow. Tight stop, maybe 130, 129 and change. If we break down here and it stops falling and we got to get back in at a higher price around 132, so be it. Roughly 13,250 on the Dow. Gold. Let's talk about gold. We mentioned last week on the video that we thought there would be a bounce here, but certainly the trend hasn't changed. That's a counter trend trade. If you were to take this, we're not, but if you were to take it, I would have my stop now under these lows that we put in Thursday, roughly around 159 and change. Maybe we get a bump up here to the 50-day and resistance around 166, which I think is 1,700 on the futures. I wanted to show you this, though, because what you want to be aware of, and this is one of the reasons we use mental stops for the most part, as opposed to hard stops, because somebody probably took this long trade here and they said, you know what, I'm going to put my hard stop just under this candle. And they were taken out, and then before they know it, 2 huge days in GLD, and it just happened quickly, and they never got back in. So having a mental stop is a good way to go, more often than not. But putting hard stops in is fine. Just be aware that if something like this happens, you might have to get back in if the chart pattern looks highly probable. But really, the only thing I see working right now is equities. I don't see crude working. I don't see treasuries working. I don't see the metals working. Now, that's not to say they're not bouncing off support, but the overall trend is down. Let's take a look at oil. This oil chart is pretty much the opposite of the Dow chart. And whenever this wants to pull up. All right, so we have this downward sloping trend line against a flat base or support. So the pressure is what? The pressure is down, right? Because it's pushing against a flat base or support. And again, this became self-fulfilling. We broke through the 50-day moving average. We might have caught support, temporary support yesterday here. If not, we're going to probably take it to here, possibly here. But we put out this post on the 23rd as well. We said, will crude run? In a question mark. Safer entry above 27.60, above 28. So you want to wait for those to get up there and get through it, unless you're going to play some type of bounce. Or if you were to play a bounce here, you'd want to have your stop in place. So again, this is the opposite of the Dow. That doesn't mean the Dow has to play out, but see how this pressure is going down against this flat base, where again, if we pull up a chart of the INDU, we have just the opposite. We have this upward sloping trend line pushing against resistance, which the odds favor that we're going to push higher, but in the event that it's a false breakout or a head fake, we want to have our stop in accordingly, either a mental stop or a hard stop. All right, so that's treasuries. We covered oil now, gold, covered the S&P, we've covered the diamonds. This is a stock that we like here. We like the chart pattern. As always, anything could break down. But this is J&J here. Again, we're looking for things, especially now, that are coming out of bases, where we can have a stop where we're comfortable under support. The farthest we would go back here would be, just like a buck and a half, which is a low percentage from 65.96. But these are some lines I drew in this morning. I think I put the still chart up on the blog today. And here's what it looks like on a weekly basis, weekly chart where the candles are weeks. Would it be better to get through 66, 60? Sure. Could this break down? Yes. But as it stands right now, this is a decent looking chart. I would think the volume was up today on J&J. Let's take a look at the daily volume. Yeah, up a little bit. So there we are. There's another chart that I wanted to pull up that failed this week, but we didn't take it. We said we wanted to wait. I can't recall what that was offhand. It's on a still chart. But in any event, that's it, you guys. The overall trend is long. We are moderately bullish. So we're cautious here. We get through some congestion next week above going into new highs. We'll increase our long exposure with always the plan in mind that if we break certain areas of support, we're going to get out, whether we take a small loss or we lock in a profit. All right, that's it, you guys. Doug McKay, antiwallstreetguy.com. Welcome to the new radio listeners. We'll see you guys next week on the blog. Thanks.